Good morning. Welcome to our session on profitability and perception challenges in digital payments. My name is David Chung. I am a partner with Simon-Kucher and Partners, based out of the New York and Toronto offices, and I focus in our financial services practice primarily in the payments sector. And today I have two esteemed guests with me to discuss the topic around payments and profitability. The first is Philip Daniel, and the second is Abhimanyu Julaniya. What I'll do is I'll have each one of them go ahead and provide a brief introduction to themselves and their experience in payments. Philip, why don't you take it away first?
Sure. Thanks, David. Firstly, thanks to Payments Canada for the opportunity. Abhimanyu, hello. A very quick brief about TerraPay first, and then I'll talk very quickly about myself. So TerraPay was established in 2015. We are headquartered in the Netherlands. Our investors include IFC, which is part of the World Bank Group, Partech and Prime Ventures, which are venture capitalists. In simple terms, what we do is we build and manage a payments highway or a payments infrastructure, which enables our partners and their customers to send cross-border payments into more than 78 countries. And this includes payments into around 4 billion bank accounts, almost 400 million mobile wallets. We are a B2B player in the sense we only partner with licensed entities, and 100% of our payouts are happening through digital forms. For example, we only do bank accounts and mobile wallets. We do not touch cash at all in our system. We focus on instant payments. To give you some statistics, so 97% of our transactions happen real time, which means it gets credited or delivered into a wallet or into a bank account in less than 1 minute. That's the kind of speed of service which we provide. In terms of the regulatory and licensing, so we have been licensed and we have regulatory approvals in almost 45 plus countries. Today, our partners include the who is who of the industry, like Western Union, MoneyGram, Ria, TransferWise, Sendwave, you name it, and we have it. And we also have on the receive side the banks and the telcos which use our service. About me, I joined TerraPay last year. I am the regional director for TerraPay for North America, and my main focus is US and Canada as a send market. I have almost 15 plus years in the industry. So what I've been doing last 15 years is purely remittance and cross-border payments. I was based out of Dubai for the last 15 years, and I'll be moving to Canada very shortly. That's it. Thank you.
Thank you so much, Philip. And Abhi, do you want to provide a quick intro to yourself as well?
Absolutely. So I'm Abhi. I'm a director based out of the London office at Simon-Kucher, being focused on financial services and particularly payments. Within the payment scape, I've been working mainly on the B2B side, where I look at payment schemes, working with PSPs, acquirers, as well as remittances players.
Great. Thanks so much, Abhi. So as I think about our agenda for today's conversation, I think that as we think about the overall topic around profitability and perceptions, I think one of the things that really resonates with me is better understanding our clients and our end customers' needs to help to address those type of perceptions, and also to understand what is the right way to monetize some of the value that we're providing in the marketplace today. And so as part of the major sections that we'll tackle, I think the first is really going to talk about client needs and end customer needs. And then from there, I think we'll want to talk a bit more about how these needs have impacted how you go to market. And then also, very importantly, what is the monetization strategies that we're seeing out that you've seen in your personal experience at TerraPay, or your experiences, Abhi, across various payment providers that you've worked with? How have they gone to market from a monetization strategy perspective? And how should other players be thinking about it based on some of the dynamics that we're seeing in the market today? So to start off, focusing on the first section around client and end client needs, Philip, maybe the first question to you, since you have more direct interactions with end clients. What are some of the main changes that you've been seeing in your clients or your end customers' needs in terms of payments? And how has that evolved over the last year, especially given COVID?
Yeah, we're seeing a major shift to digital payments across the payments landscape, and that happens at multiple levels. Starting with companies who are into this, everyone is constantly expanding their digital infrastructure and capabilities. We talk about the first and last mile customers. They are demanding more and more digital payouts or digital options on the send side. And we also see a major change from a regulatory angle, which is extremely important for this industry, that only when the regulators also join the requirements of the companies who provide it and the customer, then only we can the whole landscape gets formed. So these are the three main areas which we see: the companies, the customers, and the regulation. That's the major change which we are seeing.
Yeah, and maybe just to add on to that, right? I mean, those are some very similar trends that we are seeing in the market as well, especially if you look at customers' changes going into more digital means, especially with the onset of COVID, right? Like we are seeing people move into more contactless payments. We are seeing more use of cards over cash, mainly driven also by COVID. I mean, we had these changes going on, but these seem to have been accelerated. And obviously the implications are seen across the entire payment scape, right? So on the one hand, there are these merchants who have to cater to these customers who are looking for more digital means, right? So the question becomes, okay, how can they offer the latest and the newest payment methods, keeping the line or keeping the customer changes on the one hand? And on the other hand, what has also happened with the lockdowns that came in as a part of COVID is that there has been a lot of shift towards e-commerce or online purchases, which have meant that merchants that traditionally had a very strong in-store presence, but not necessarily an online presence or not as strong as an online presence, they have shifted their attention to making sure that they cater with the online channels, which then has had an implication on PSPs and acquirers, which need to make sure that they are catering to their merchants by offering them the relevant solutions and offering it in a very smooth and seamless way. So instead of, let's say, going in and having two contracts, one for an in-store, one for a mobile channel or an online channel, creating a single omni-channel solution, right? And on the front end, it could be about the commercial side or the paperwork side, but on the other side, it's all around the user experience or the merchant experience, right? They also want a single portal. They want combined services, easy way to do all the reconciliations and all, which has then had implications, or anybody who is in the back end in terms of doing the infrastructure part, in terms of doing the processing, so that they don't have to work with these different channels or different systems, and how can they actually make sure they are working in a fairly integrated way. So a lot of these changes that we're seeing on the digital side have implications throughout the entire payments landscape and the industry, going from merchants to PSPs, acquirers, to infrastructure providers behind them, as well as software solutions that do the entire payments handling. So we are seeing quite a lot of dynamics in that sense.
Yeah, a lot of great information, Abhi. Maybe two follow-up questions to that. I'm wondering, as you're talking about these dynamics, are there specific segments that you're seeing that are indexing higher or that are being affected more, or you're seeing greater amount of change versus those that are not? So that's one follow-up question. Maybe you can start with that.
Yeah, sure. So I think there's definitely a huge shift, and these would be typically the industries, as we were talking about, right? One on the one hand, that had a very high in-store presence, right? So those industries obviously are seeing a lot of change. And when you're looking at the traditional way in which the payments were processed, and you had a very fragmented landscape, that is getting affected. So maybe if I were to think about it in a slightly more macro view, there's one view in which we look at the industries themselves in terms of customer segments, where we are seeing a bit more focus. So for example, right, if you're thinking about travel, there has always been, let's say, the possibility of accepting payments by credit cards or debit cards. There's more increase in terms of getting new payment methods, such as whether it's buy now, pay later through Klarna, or whether it is through direct open banking, such as with the likes of Trustly or so forth, right? So the entire game has there shifted in terms of, as people are moving online, what can we do to improve our conversions? And in that space, the trend is changing to how competitive the entire industry is. So where the competition is more towards online, more pressure. So travel especially is one of the sectors, especially also driven by COVID, that is seeing a lot more emphasis. And maybe on a slightly different side, right? Like when we think about PSPs, acquirers, on the other hand, the dynamic is slightly different because until now, until the last couple of years at least, the small businesses had been taken over by some of the more innovative and new age players, such as Square, for example, right? Now they're seeing the bigger players are finding that this is a pretty opportune space, and especially as a lot of the mom and pop stores and the online retailers, the smaller ones, are moving into this space, this aspect of the industry or part of the market is also seeing a lot more entrance or attention from the different players.
Understood. And how about you, Philip? Any additional perspectives from your point of view?
Yeah, absolutely. So adding to what Abhimanyu said, so specifically for the cross-border payments industry or the remittance industry, this change actually happened a couple of years back, both on the send and the receive side. To name some of them, like if you take Kenya, M-Pesa, years back changed the entire way international remittance happen. I mean, majority of the Kenyan population has an M-Pesa, and we've been doing a digital payments into these wallets years back. And similarly, on the send side, if you take the big online money transfer companies, they all innovated. They actually started this process a couple of years. But as Abhimanyu rightly said, COVID completely changed the game. And now, if you talk about cross-border payments, you talk about big markets like India or the other Latin American markets or across the world, cash payouts was a preferred way of receiving money. And that has significantly changed. And now because of, think about lockdowns, as we speak, it's lockdowns across the world, and then people can't even step out to get their money. And that's where the digital payouts has really, driven further increase, not just from the companies which have initiated it this years back, but again, from a customer perspective, so that's the big change which COVID has brought these days. Yes.
And maybe just another thought on that one is, right, like one thing that we've also seen in the last couple of years has been more and more financial inclusion in terms of the developing countries, right? So as you rightly pointed out, Philippe, that there's a lot of mobile money wallets, right? So obviously it started a lot with M-Pesa, but it's spread across parts of Africa, Eastern Africa in particular, as well as Southeast Asia, right? As well access to bank accounts. And obviously the implications there are that for money sending businesses or MTOs, for example, the more they are able to cater to these particular channels, the more they're able to differentiate themselves on the rest of the market. So being present on these digital or the non-cash based channels has become very prominent.
Great. In thinking about some of these dynamics that we were just talking about, and maybe this is specific to you, Philip, how are you seeing these dynamics impact your business at TerraPay, and how has TerraPay reacted to some of the some of these influences that are happening because of COVID and the more people moving online and so on and so forth? What's some of the things that you've seen happen so far?
It has definitely impacted TerraPay in a big way. I'll firstly talk about, so the vision with which TerraPay was founded, as I said, is purely digital payment. So we do not touch cash in our system. So right from the beginning, or the vision of the founders was that we will only do digital payouts. And maybe I can say thanks to COVID, and 2020 completely changed the game. As I said, across the world, starting from customers, companies, and the regulators then shifted their focus to accommodate this digital payout. So that really helped a company like us and our partners, who also shifted from the brick and mortar setup to the digital payment. So the biggest impact was on our growth, and I'll probably take some numbers here. So we have something called as a sales value, a GSV, which in 2020 we had a growth of around 300%, and we are expecting almost a similar growth this year. And I'm sure this is going to further increase in the coming year. So overall, our business has skyrocketed along with our partners. The other way it has positively impacted us is that we were able to give more opportunities or to a lot of people. So to give you some numbers. So in 2019, we were around 38 people and in 2020 we ended up with around 81 people, and we have hired across all functions very senior people joining TerraPay in different markets, and this year we'll be ending up at around more than 200 people. So that's something again which has helped us to expand across all functions with people. The other important aspect is that we are now focusing on adding more verticals to our business. So currently what we do is like 99% of our core business is P2P cross-border remittance. We have launched our B2B remittances. We are in the process of scaling that up. We will also be launching more payment related products and solutions. This also helped us to expand into new markets. So as I said, currently we have around 78 countries which we help our partners and the customers to pay out, and that will cross 100 by end of this year, and the next year our target is to cross 200. This has also helped us to expand into more send markets. So today we have people across Europe and Americas and the Middle East, both on the send and receive side, who are working to expand these markets, and also from a licensing perspective. So we're quite license hungry. We are in the process of getting our licenses in the US. Our e-money license in Lithuania is in progress, and Singapore and many markets. So these are some of the important aspects here.
Maybe one of the things I wanted to ask is that as a result of some of these dynamics, especially as a result of COVID over the last year or so, you mentioned that there are some additional feature functions that you're launching. Were there any of these things that were in direct reaction to the changing market dynamic, or were these part of your roadmap already as you're developing these capabilities?
So this is like, one, we constantly observe the dynamics of the market, what our customers want, our partners want, what is the regulation. So based on these and the feedback from our partners, we constantly come up with new products and services. So currently we are partnered with the who's who of the industry, like I said, Western Unions and the MoneyGrams and the RIAs and all of them. So anyway, we have a connectivity with them, and we can also offer them using the same API, the same contracts, the same connectivity, one more solution, which is B2B payments. Now, B2B payments is quite different from P2P payments. So currently, if you take TerraPay, the average ticket size is around $400. When you go to B2B, it's a completely different thing, and your requirement from a compliance perspective is completely different. But it's an extremely important aspect when it comes to cross-border payments, whether it is trade payments, whether it is for educational purposes. It also is part of supporting the communities around the world for meeting their multiple requirements. Another aspect of another solution which we are working on is, I mentioned that we are now connected to 400 million mobile wallets. So today we have M-Pesa or the MTN or the Orange. So what we are trying to develop is also an option for the customers for a request to pay. That means what we do is we send money into a wallet, but we are in the process to enable the customers to also make a payment or a purchase or an e-commerce, etc. This is also in the pipeline, which is again coming back to your question, based on what our customers are asking for, the opportunities around the market, the regulatory environment, considering all these factors is how we come up with these solutions and products.
Got it. And Abhi, actually a similar question, maybe a broader one from other payment providers that you and I have worked with. I'm just curious if some of the market dynamics you were just sharing earlier, I think you may have touched on this as well. These have created some opportunities, right? And what kind of opportunities have these created for some of the payment providers? And what are you seeing what type of innovations are you seeing that are being created to address some of these needs?
Yeah, so I think one of the biggest changes that we're seeing in the market is, as we were talking earlier, right, the PSPs and acquirers, and even if they are the ones that are run by banks, they're moving towards offering a more consolidated view of the entire channels, but also the new age payment methods that are coming into the market. What that has actually had an implication on is the overhaul of their entire payments infrastructure, right? So until now, what the banks had been doing, or PSPs, or third-party payment processors had been doing, they had a legacy payments solution, right, or software, and they had stuck on a bunch of additional pieces on them to make their systems function. And the implication of that was that anytime that a change was required, it was extremely time consuming. It could take 6 months to a couple of years to make any kind of small change, to introduce a new payment method, to integrate with a partner, right? So I guess in the case of TerraPay, if a bank wanted to integrate with them because of the legacy solutions, it could take a couple of months, right? Unless they had an API set up, or the core banking system or legacy payments processor could handle that, right? So because of all the changes and the competitive pressure that's coming on to offer these new age payment methods, there has been a shift to upgrade and enhance their entire payments infrastructure. And these programs are something that the tier 1, tier 2 banks, or anybody who's looking to be innovative, is now undertaking. So yeah, that is something that we are seeing as one of the big changes. And obviously the key advantage is that they can offer instant payments, they can offer buy now, pay later services. And these are some things that would work on the one hand really well for B2C customers, so working with the more retail side, but equally has implications for the B2B part of the industry, just in terms of making yourself more flexible, making yourself faster, so that your entire proposition to customers as a bank or as a PSP acquirer is much stronger and helps you to have that edge in the competition, right? Because what we're also seeing in the entire payments landscape is there's a lot of vertical consolidation. So on the one hand, you need to carve yourself out or carve a name out for yourself based on your proposition, but that just is not enough, right? Because of the constant changes in the market, you need to be pretty in a shape that you're able to move fast, right? So those are some of the dynamics we are seeing, which has had implications on the back end as well. And obviously, because as competition is increasing, the other players in the market are also forced to come up. I think that's something that I would probably point out.
Yeah, let me follow up with a couple of questions on that. So I totally understand the dynamic that a lot of these tier 1, tier 2 banks are definitely trying to upgrade their legacy systems, right, in order to be more agile, to offer more payment options, to have a more seamless experience. All of the benefits are, I think, quite clear. But my sense is that it's a pretty big transformation, right, in terms of having to replace the overall systems and having to make sure that they continue to operate seamlessly and consistently. What are some of the challenges that you think are more evident as they're thinking about these type of transformations? I mean, it's a pretty big undertaking in terms of trying to rip and replace, or at least run parallel systems in order to make things work. What are some of the major ones that you're seeing that are probably the biggest hurdles that they have to overcome?
I think the biggest hurdle is probably, I would say, two. One is the scale of the cost, right? So just a pure transformation program without any license fees and all can cost up to as much as $100 million for making this rip and replace part of things. So that's one cost side of the implement. But I think a bigger risk is that when they're doing this transformation or when they're doing this migration, in case something breaks and they're not able to service their customers, right? So every now and then we keep seeing that banks, their ATM networks are down, or their entire payments infrastructure is down. That is probably the last thing that any of the banks, whether it's tier 4 or tier 1, wants to happen, or even a third-party payment processor wants to happen. So the biggest part is obviously there's the cost element, but even bigger than that is this entire risk of making sure that their service is uninterrupted and they do not have any kind of negative reaction with their customers, right? Because for a big bank processing about 1 billion transactions or so in a month, even a 30-minute outage or days outage is a significant loss, obviously, in the transaction business, but also in terms of the reputation and name on the market. So yes, there's a big cost element, but even bigger than that is the reputation and business continuity element.
And I'll add to that on the challenges part. So for us, the biggest challenge which I see or we see at TerraPay is de-risking by banks. So we are in the business of moving money, and as I said, it's now P2P business. The average ticket size is as low as $400, but when I send money to someone in India or in Africa, the money is received within seconds. I gave you an example. 97% of our transactions happens in less than 1 minute. But behind the scenes, there is a whole lot of settlement which is happening, right? So we pre-fund our partners on the receive side, our partners on the send side pre-fund us. All these happens through SWIFT, and it is lifeline for our business that we have settlement bank accounts in various currencies, whether it is in USD, in euros, or the local currencies. While TerraPay has enough accounts, what we are also trying to do is to open accounts in all the licensed markets where we got license or we started our operations. To give you an example, we very recently got our license in Canada, the FinTrack license, and we are yet to open our Canadian dollar settlement account. So once we open that account, it becomes much easier for our other partners in Canada who can settle us in the local currency, and then the money movement, the settlement of the money movement becomes much easier. But considering the banks, take on de-risking, they don't want to be into a risk business. This is certainly a challenge for across the industry, and this is there for many years. And for someone like TerraPay, who's purely focused on digital business, we don't touch cash, as I said, is also a challenge. So that's the biggest challenge for us, which we are facing.
And maybe something that I've also seen a similar light with is with some of the larger merchants. What they do is they typically work with multiple PSPs and acquirers, and there are two reasons, right? One is the risk element, that in case one's network goes down, they have another aspect or another provider to work with. But on the other hand, what we have also seen is that their merchants are getting even more sophisticated in terms of how they route their transactions. So depending on what the interchange fees are, what the particular scheme fees are, they look at which payment processor or acquirer is giving them a better rate or better deal, and they route the transactions in a pretty sophisticated manner. So I think we're seeing definitely that on the merchant side, the larger ones, they are increasingly getting more involved in figuring out the nuances to both mitigate the risk, but also, on the other hand, optimize their costs.
Great, thank you. Maybe I'd like to pivot a little bit and talk more now on the monetization side. So I think in the prior session or the prior half, we were talking more about the needs and some of the market dynamics. And now let's talk about the monetization strategies that we might see in the market. So maybe first to start off, Philip, you can share a bit more about your specific monetization model for TerraPay and how currently you go to market with your current value proposition. And then I'll turn to Abhi to talk more about some of the other monetization models that we're seeing in the market, if that makes sense.
Yeah, absolutely. So our mantra is I think Abhi touched on that point. It's a single API, a single agreement, and a single settlement for our partner. So what this means is a send partner, let's say in the US, currently is just focused on, let's say, Latin American markets. And it is extremely difficult for them to build a big network, let's say in Asia or in Africa or in Europe. And that's where we step in and sell this idea of a single API, a single agreement, and a single settlement that opens 78 countries for the partner. Right, so that itself is a very big thing for the partner, and that's our USP. And within these 78 markets, we focus on instant, cost-effective, and compliant digital payments. So it's extremely important that we these days compliance comes first and everything else comes second, right? So that's also equally important. So that's our key mantra, and that's the main reason that we today are partnered with the who's who of this industry.
Understood. So let me see if I can clarify my understanding. You have an API that you are using to connect, and essentially, are you charging on a per API basis or per API call basis based on the number of transactions that are happening, or is it?
So the process is we partner with, let's say, a money transfer company, an MTO or a bank or a telco. There is a single contract with them, a single API connectivity, and then once they settle us, let's say pre-fund them, we then enable instant payments to any of these countries. For our pricing model is a fixed fee per transaction, and then there is also an FX component on it. We also understand the importance of high volume, low margin business, because essentially we are a payments infrastructure company, or some people call us as an aggregator, right? So we offer this service to someone like a Western Union, and the Western Union is further offering this to their agents. So there are more layers into this business. So our model is a high volume, low margin business. But where we make money is purely on the per transaction fee, and there is an FX component to it. But again, we are extremely competitive on the FX rate. So in fact, we most of the times go up to our cost on the FX. So mainly the component is the fee part of it.
Understood. And Abhi, just to bring this up to more of the market level, or other players that you see in the market, what type of pricing pressure are you seeing? Is it fairly compressed prices these days, or do we see some price premiums that certain providers are able to eke in the market? What are some of the trends that you're seeing at the moment?
Sure. So maybe taking on from what Philip was just talking about, right? So payments has been typically a consumption-based business, right? Whether you're consuming transactions or whether you're doing, whether it's the number of terminals and so on, right? So it's been a pretty transaction-based business or consumption-based way of charging. What we are seeing creativity are around 2 or 3 things, right? So one is in terms of if you have multiple pricing levers, right? Whether it's a fixed fee plus a percentage fee, depending on what the customers are more focused on, going low on one versus going high on the other. So in the case of Philip, right, as he was just mentioning, they are pretty competitive on the percentage part and they make more money on the fixed fee part. In some of the other industries, or depending on the verticals, we are seeing the other part that they're more competitive on the fixed fee but making money on the percentage part. So there's one about what are the price levers you have and how do you rebalance that. So I think that's one part we're looking at. The second part that we have been typically seeing is, or what the companies are doing is they are going deeper into understanding where is this price pressure coming from and where is this pricing pressure less, right? So in a case of, let's say, a payments example, there's been a tendency to look at it in a two-dimensional way. One is, what is your average ticket size? So if you're charging a fixed fee, the average ticket size has a huge implication, because for the same fee, a small ticket size will make it a pretty expensive proposition. Whereas for a very large ticket size, the same fixed fee would be a very small part. So the thing that a lot of companies have started now doing is, how do we make sure that we calibrate our prices so that this fixed fee is lower for the lower ATVs and higher for the higher ATVs, so that it is aligned with that. On the flip side, the equation is inverse when you're looking at percentages, right? Because if you're going with a 2% price for $1,000 transaction versus $10 transaction, the implications are pretty different. So the idea is that for higher ATVs, you're charging a lower percentage, and for the lower ATVs, you're charging a higher percentage. So there's this element of how can we be a bit more creative with our price levers on the one hand, and for a particular price lever, how can we be smart about making sure that we reflect the willingness to pay or price sensitivity. And obviously, right, you have the ATV element, and then the other element is what is the size of the business, right? So obviously, smaller businesses are typically less price sensitive, and the larger businesses, often with their own procurement teams, have a much stronger negotiation power. So then if it effectively becomes by a two-dimensional grid where you have prices that vary by the ATV and prices that vary by, let's say, the volumes. Or you could also have prices that vary by different verticals, depending on how much margin they make, how much competition is there. So those are some of the dynamics we are seeing. And potentially a third thing I would say is more in line with the subscription. And this is something that we're seeing pick up on probably 2 parts of the market. So one is when we're thinking about the smaller businesses, right? So PSPs, acquirers, they are creating packages, always because for the smaller businesses, payments is something that is obviously at the bottom of their list, right? Or least of their things that they want to worry about or they're familiar with. So how can we make it as simple for them? On the other hand, in a lot of industries or payments industry, we are seeing a move towards as a service model, right? So whether it's solutions that are being provided by TPPs, PSPs, or by software providers, right? So what they're doing is they're providing on the cloud solutions that can be used by the smaller businesses and making it an all-inclusive service on the cloud so that it's scalable, it has everything, and literally takes away the entire pressure and the hassle of managing payments. So there's a bit of move in there. And on some of the larger corporations, there is an attempt to charge subscription basis. And there are a few companies that are doing it a lot better than the others. So we're seeing a few changes in terms of the price models, the price metrics, as well as the eventual models to charge through.
Yeah, very interesting. I think if I could summarize what I've heard so far, it sounds to me that there's always going to be some sort of transactional component. It's going to be very tough to move away from some sort of per transaction type of pricing model. At the same time, we see that based on certain needs, either on the smaller end with small businesses or on the enterprise side with large, there may be room to charge more of a subscription type of fee to include certain number of transactions to make the overall buying process a bit simpler, especially on the small business side, but also establishing a kind of like a subscription model for the enterprise level in sort of a way to establish a more of a fixed fee with a certain number of transactions included, and then still be able to monetize on the growth of transactions as they kind of transact more, kind of more like a barbell effect to a certain degree. But I think, is that basically the gist of what I've heard so far, or are you seeing other developments of other types of pricing models in play?
Yeah, I think that's absolutely correct, that the way you've described it, David. I think one other thing that I would probably add is that when we are thinking about especially the larger enterprises, these are always negotiated contracts, right? And one of the biggest problem comes in, how do you ensure that the conditions for which you gave a better price are actually respected? And what we're seeing is that where the subscription model comes into play is it dictates at what prices or like at what subscription prices or volumes you get which price, right? And if they're not respected, then you move up and down the tiers. And that's something that we're seeing increasingly being done.
Oh, great, thank you. And then maybe Philip, on the TerraPay side, what are you seeing in terms of price pressure? Oh, sorry, if you had others to add to Abhi's comments, feel free to do that too.
Yeah, so pricing is extremely important. I mean, we see that across any industry. I mean, you see competition if you offer someone a pricing, and then there would be someone else to match it. But again, as I said, it goes back to our mantra. So it's not just pricing. As I said, the demand is for offering the customer and the partners an instant, cost-effective and compliant digital payment. So pricing is certainly a factor. So that's where, when we talk about a fixed fee pricing, we are also eliminating a lot of other costs for players. For example, especially mid-sized players, as I said, who don't have the infrastructure to go and set up an infrastructure in a receive country. For example, if you want to set up Asia remittance arrangements in many countries, you would need to have an office, you need to have people, you need to have a lot of cost associated with it. You need to have licensing from the regulators. So when you partner with TerraPay, you're eliminating all these costs. You also need to separately settle in all these markets. Coming back to the de-risking by the banks, the bank account issues, you need to fund in different currencies. That SWIFT will take 2 or 3, 4 days. It might delay in the customer experience. So for us, yes, pricing is there. It's an important factor, but there are many other factors which we compensate around that, and that's where really TerraPay plays a lot of value for our partners.
Go ahead, Abhi.
Yeah, so I was just going to say, I think Philip brings in a very important point, right? Like, we have been talking about pricing pressure, and to be honest, like, we are seeing pricing pressure increasing in payments, but that doesn't mean that we have to go down a path of reducing our pricing, because one of the key things to understand is what is our value proposition, right? And how does it compare versus the others on the market? Do we have a better reputation? Do we have a wider range of products? Are we a one-stop shop? Do we have a better or more performance solution, right? So these are all the things that come into play in terms of making sure that, hey, what is the value we are delivering on the one hand? Is there somebody else who can deliver that value better than we do, or are they actually miles apart? So all of these obviously have to be taken into consideration before somebody decides to start reducing the prices, because we've seen countless cases where people are like, oh, there's pricing pressure, let's reduce our prices. They go ahead and do that, but then what they realize is they don't actually get any kind of volume uplift, because it's not as if it's very easy to switch a payments provider, especially for the larger organization. So there's a lot of stickiness in there. So I think we have to be pretty smart about where the pricing pressure is. Does it really affect us? And should we be making changes or reducing our pricing, right? Because in a lot of cases, there are pockets that you can obviously increase your pricing, and on the others, you just maintain your pricing, considering your value proposition.
I'll just add one more point to a very important point. So, TerraPay has played a very significant role in also reducing the cost to the first mile customer. So, for example, cash payouts. Now, all these shift from cash payouts to these digital payments. Earlier, cash payouts is considered to be expensive compared to digital payouts, because on the receive side, someone has to travel, let's say 10 kilometers, and then go to a small store and buy and withdraw this money, where the merchant is also charging a percentage of probably the value, so it is quite expensive. Now, when we came into play, our fixed fee, which we consider is very competitive and very low, has helped certain markets, especially in Africa, to further reduce the customer fee. So let's say we charge a fixed fee of X dollar to someone like a Western Union, and Western Union is actually further reducing their cost. When they do it directly with their partner or a cash payout, their cost is high. So their cost is coming down. And if a send partner wants to still keep a decent margin and then reduce the customer fee, that is possible through TerraPay.
So it's win-win for all.
So you made a pretty good point earlier around how the value proposition should shape what the pricing strategy should be, and we shouldn't always be pressured by the market to always decrease our prices. And I'm just thinking that there are obviously various strategies that we can take to ensure that we're not devolving into a price war. And one of the topics that come to mind are around value-added services, and how, as providers, as providers in this space, we have different ways of providing added value or premium value on top of the existing platform to hopefully push us away from having to compete on price, right? Can you talk to a bit more about what are some of these value-added services that we're seeing, especially from a payments platform or infrastructure perspective, and how are these becoming more of a priority, and how does this impact a provider's pricing strategy given these value-added services that might be introduced into the market?
Yeah, so I think that's a very good point, right? So value-added services are becoming increasingly more important, and again, depends on which part of the industry you're thinking about. So some of the smaller ones could be around PCI compliance, right? And this is something that comes in for smaller merchants as well as some of the really, really big merchants or global corporations. They also need to make sure that the PCI compliance is coming in, and a lot of consulting is also happening on this piece. There are other aspects which are going into point of sale credits. They are going in terms of merchant financing based on their turnovers. They're going into fraud detection and prevention. They're going into all the back-end reporting, right? So we are seeing a lot of these innovations come in, and the platforms, PSPs, acquirers, they're getting pretty active in making sure that not only do they offer the pure transaction processing acquiring, but also the additional services, so that they become the one-stop shop and they are able to take on more and more work from the merchants or their clients to their side, right? And the two aspects that they typically want to do that, as you were referring earlier, differentiate yourself from the competition by increasing your value proposition, but on the other hand, increasing your overall pricing power. And the way they have been typically doing it is twofold. So it really depends on what your situation is, who your clients are, and what the competition is. Because you could either just blend it in to your actual transaction-based pricing and charge premiums for this, and you make sure that you're monetizing it as the number of transactions increase. And this is something that's pretty important for most companies in the payment space, right? You want your entire business model to be scalable. So if you're able to blend it in, and your client's business is growing, which we expect in the payments industry or digital payments, you want to make sure you're monetizing it completely. So that is one approach that is seen. The other one is to explicitly monetize it. And that's typically done when you have a very strong value proposition or a strong case of selling that product separately on the one hand, and you probably have a bit more competition on the pure transaction-based pricing. So you're able to split it into two parts. So I think those are two key ways in which we are seeing monetization happening, either explicitly or implicitly. And obviously, we have seen in some cases monetization is not happening at all, right? Because often companies struggle to see, oh, actually we are providing value and customers are willing to pay for it. Often that link is missing, that we are providing these services. We believe they are not really valued by customers, but in reality, they are valued by customers and customers are willing to pay for it. So often when we do our research for our clients, we find that people or their customers are actually willing to pay, and those monies can be fairly significant. So I think paying attention to what your services are, how your customers value them, and what is the best way you should be charging for them is something that should be thought as more and more companies are moving in this value-added services direction. And obviously, right, the other big piece that we're also seeing is around data monetization, either directly or indirectly, right? You could be doing consulting services, you would be providing benchmarks on the one hand, or you could be anonymizing this data and selling it to third parties to use in their own businesses to inform the decisions better. So quite a lot of options in the payment scape.
That makes a lot of sense. And I'm wondering, Philip, for TerraPay, how are you thinking about value-added service? I mean, you talked about some of them earlier in terms of the additional things that you're developing, but how are you thinking about the monetization strategy of these services that you're adding on?
Our strategy at TerraPay is send, spend, manage, and grow. So on the send side, we already have a P2P service, and now we are also going to launch the B2B service. And the second part is spend, which is now as I mentioned, we are also launching our request to pay. For example, we are already connected to 400 million mobile wallets. We are working on an option for the customers to use those wallets to make payments or e-commerce payments, etc. In terms of monetization, the model is pretty much the same. It will be again a fixed fee plus an FX component. When you talk about B2B payments, these are large ticket size, so you can't really charge a percentage of the FX. You can't charge. Again, here also the model is a high volume, low margin business, right? Unlike a $400 transaction, you might be making a 100,000 euro transaction. It could be a real estate purchase. It is slightly different. You need to be more competitive. I think on the B2B part, you can probably increase your fixed fee component, but the FX margin percentage remains the same. You have to be really competitive, and you are competing maybe with banks and other big giants in this space. So you have to be very so whatever it is, I think we always, as I said, we believe in the low margin, high volume business. That will be our strategy here.
Got it. Very, very nice. Thank you so much. I think we're close to our time. So what I'll do is I'll have one more question, more of a forward-looking question for the both of you. And after that, I think we'll conclude and leave it up for Q&A. I think the last question I have for you, maybe Philip, you can start. What are the most pressing questions that payment providers or payment players like yourself need to answer or address for your future or to set your future strategy?
Yeah, so I think we need to keep a very close watch on how markets are transitioning at this stage. So we talked initially with the changes which is happening in the market. So we see a big change, across markets, especially on digital payments. But there are certain markets like, for example, Latin America. We still see cash is king there. When it comes to cross-border payments, it's still a preferred way of. We haven't seen a big growth of mobile wallets, unlike in Africa or in other Asian markets. Latin America is still something which we need to really closely watch. We need to also look at how the regulators are reacting, because the regulator reaction keeps changing. You would have recently heard about the Chinese regulators stand on the cryptocurrencies, right? So these things can completely change the way you do business. And most importantly, I think it is about how quickly you identify the opportunities available and how quickly you come up with innovative products and services, but at the same time, how you improvise your existing services and products.
Great, thank you very much. And then Abhi, last words in terms of most pressing questions that these payment providers or players need to do to ensure that they set a future strategy.
Sure. So I'd probably say there are three things that come top of mind, right? One is, how can you be smarter about your pricing? So as we were discussing earlier, how can you figure out which pockets of your customers, both existing and new customers, you should be targeting? Where should you be looking to make yourself a bit more competitive? Where is it that you can get more money out, right? So it's like pricing smarter and making sure that your existing customer base, which is typically more inelastic, how do you leverage that? I would say that's one part. The other part is, obviously, there are a huge set of clients that the payments companies are sitting on, and often they are sold in pretty much siloed ways. Are there ways in which we can cross-sell or upsell to our existing customers? That's a big piece, right? Is it only acquiring we are selling? Can we sell fraud? Can we sell tokenization? So on, right? Those are some of the things that the payment companies are thinking about a lot more proactively. And the third part is, which parts of the market should we really focus on, right? Which parts of the market should we really look to increase our proposition or focus our sales efforts on, depending on what the margins are, what the size of the market is on those particular segments and what the competition are. So it's like pricing smarter, increasing our cross-sell, upsells on existing base, and figuring out where the market segment opportunities lie to go after.
Great. Thank you, Philip. Thank you, Abhi, for joining me today. It's been a terrific conversation around the evolution and developments in the payment space. I think we can open up for questions. Other than that, I think thank you both for joining me today.